This content reflects my personal observations and learning process while studying financial markets and digital assets. Any discussion of trading strategies or market structure relates only to my own trading framework and personal trading system. This material is for informational and documentation purposes only and should not be interpreted as financial advice or a recommendation to buy or sell any security or digital asset. Episode 16, Liquidity and Order Flow, Why Prices Move Fast. In the previous episode, I discussed crypto market cycles and how markets tend to move through phases of accumulation, expansion, speculation, and correction. But understanding cycles explains the broader picture. Today, I want to focus on something more immediate. What actually caused prices to move quickly, especially during sharp sell-offs? When markets drop fast, many people assume the movement is caused by news or headlines. But in reality, prices move because of liquidity and order flow. Every market operates through an order book, where buyers and sellers interact. On one side are buy orders. On the other side are sell orders. When selling pressure increases, sellers begin consuming the available buy orders. If there are not enough buyers at each price level, the market must move lower to find the next group of buyers willing to step in. This process is called liquidity being consumed. Assets such as Bitcoin and Ethereum generally have deeper liquidity than smaller tokens, but even these markets can move quickly during heavy selling. Another factor that can accelerate a decline is stop-loss orders. Many traders place stop-loss levels below their entry price to limit potential losses. When the market reaches those levels, those stop orders trigger and convert into market sell orders. That adds additional selling pressure to the market, which can push prices lower even faster. But cryptocurrency markets have another layer that can amplify moves even further. That is leverage. Many traders use borrowed funds through derivatives to increase the size of their positions. When the market falls far enough, some leveraged positions reach liquidation thresholds. At that point, the exchange automatically closes those positions and sells them into the market. These forced sales are known as liquidations. Liquidations can create a chain reaction where falling prices trigger more liquidations, which then push prices even lower. Another important factor during rapid declines is sentiment. Cryptocurrency markets trade 24-hour a day, and participants react quickly. When prices fall rapidly, fear often increases. Some traders exit positions quickly. Volatility expands, and the emotional reaction can add even more selling pressure. But markets cannot move in one direction forever. Eventually, the market reached a level where buyers begin stepping in again. Selling pressure slows, liquidity begins to rebuild, and price stabilizes. This is the point where the market begins searching for support. For someone studying this market, the goal is not to react emotionally to every rapid movement. Instead, it is to understand the mechanics behind the movement. Because when we understand liquidity, order flow, stop-loss triggers, leverage, and sentiment, we begin to see that market moves often follow a structure. And as with every episode in this series, the goal is not speculation. It is understanding how the market operates. Because before capital moves, understanding should always come first,